You know, most people think investing is about being clever, about predicting the next big stock, timing the perfect entry, or outsmarting everyone else in the market. Benjamin Graham saw something very different. He lived through moments that would terrify even the most confident investor today. He watched fortunes disappear overnight. He watched intelligent people panic, sell, and never recover. And from those experiences, he reached a conclusion that changed investing forever. Benjamin Graham was born in 1894. By the time he was a young man, he had already witnessed something most investors never truly understand until it's too late. Markets don't move on logic alone. They move on emotion, fear, greed, overconfidence, desperation. Graham didn't just study numbers, he studied human behavior. And what he learned was simple but uncomfortable. Most people don't lose money because they're unlucky. They lose money because they don't protect themselves. Early in his career, Graham was brilliant, ambitious, and confident. Like many intelligent investors, he believed that deep analysis alone could shield him from disaster. Then came the crashes. The kind that don't just shake markets but shake your identity. The kind that make you question everything you thought you knew about money. Graham watched strong companies collapse in price, not because they stopped functioning, but because investors lost control of their emotions. He also watched bad companies soar, fueled purely by optimism and speculation. This contradiction fascinated him. How could prices move so violently while the underlying businesses barely changed? That question became the foundation of his life's work. Graham realized something that most people still struggle to accept today. The stock market is not a weighing machine in the short term. It's a voting machine. Prices reflect opinions, not reality. And opinions can be wildly wrong. If you don't respect that truth, the market will eventually punish you. Instead of trying to predict the market's next move, Graham focused on something far more important: survival. He believed that the first rule of investing was not making money. The first rule was not losing money. Everything else came second. He taught that investing should begin with defense, not offense. Before thinking about returns, you must think about risk. Before dreaming about profit, you must think about protection. Because if you lose too much, you may never recover, not financially and not emotionally. This idea led him to one of the most powerful concepts in finance, the margin of safety. Graham believed that every investment should be made with room for error. Because humans make mistakes, economies slow down, industries change, unexpected events happen. If you buy assets with no margin of safety, you're assuming everything will go right. History shows us that assumption is almost always wrong. He compared investing to crossing a bridge. If a bridge can hold 10,000 pounds and your truck weighs 9,900, you might cross it once. But a wise engineer builds bridges that can handle far more than expected. Graham believed your investments should be built the same way, strong enough to survive stress, not just ideal conditions. This philosophy protected him when others were destroyed. During market crashes, Graham didn't panic because he had already accepted volatility. As part of the process, he didn't see falling prices as danger by default. He saw them as emotional reactions, sometimes justified, often exaggerated. But here's the twist most people miss. Graham wasn't optimistic. He wasn't pessimistic either. He was realistic. He understood that markets will disappoint you at the worst possible time. So he built his strategy around discipline, not hope. He warned investors about something he called Mr. Market, an imaginary business partner who shows up every day offering to buy or sell your shares at wildly different prices. Some days Mr. Market is euphoric and overconfident. Other days he's depressed and fearful. Graham's lesson was clear. You are not obligated to listen to him. You can ignore him entirely unless his price makes sense to you. Most investors do the opposite. They let Mr. Market control their emotions. They buy when prices are high because everyone feels confident. They sell when prices are low because fear feels unbearable. Graham taught that this behavior turns investing into speculation and speculation into eventual loss. He believed that successful investing requires emotional distance. You must be willing to look wrong in the short term to be right in the long term. You must be willing to sit quietly while others chase excitement. You must be comfortable doing nothing when the market begs you to act. This mindset wasn't just theory. It was tested again and again across decades of economic chaos. Graham lived through the Great Depression, one of the most brutal financial collapses in history. He saw banks fail, unemployment soar, and investors give up entirely on stocks. Yet even then, he believed opportunities existed, not because the world was optimistic, but because prices had fallen far below reality. He taught his students that patience is not passive. It's active restraint. It's the ability to wait while others self-destruct. One of those students would later become the most famous investor in the world. But before that happened, Graham had already planted the seed. Investing is not about excitement. It's about endurance. And endurance begins with understanding risk. Not just financial risk, but psychological risk. Because the greatest threat to your portfolio isn't the market. It's you. Graham believed that if you could master your behavior, the numbers would take care of themselves. If you could remain rational when others became emotional, you would already be ahead of the majority. Not because you were smarter, but because you were disciplined. This is where most people fail. They look for complexity. Graham offered simplicity, but simplicity is uncomfortable. It requires humility. It requires accepting that you don't know the future. It requires building protection before chasing reward. By the end of his life in 1976, Benjamin Graham had influenced generations of investors across the world. His ideas weren't exciting. They didn't promise overnight success, but they worked quietly, relentlessly, across decades. And the most important lesson he left behind wasn't about stocks or bonds. It was about behavior, about patience, about respect for risk. Because in investing, survival isn't optional, it's everything. What Graham understood better than most was that time is the investor's greatest ally and also their greatest test. Time exposes impatience. Time magnifies mistakes. Time rewards discipline. Most people say they want long-term wealth, but their behavior reveals something else. They want short-term comfort. Graham knew you can't have both. He often said that investing is not an activity where intelligence alone guarantees success. Some of the smartest people he knew lost enormous amounts of money, not because they couldn't analyze balance sheets, but because they couldn't control themselves when prices moved against them. Fear doesn't ask whether you're intelligent. It only asks whether you're human. This is why Graham separated investors into two categories. Not rich and poor, not professionals and amateurs, but defensive and enterprising. The defensive investor wasn't lazy. They were realistic. They accepted that the future is uncertain and built their strategy around protection. They diversified. They avoided speculation. They focused on consistency, not brilliance. Security will follow. Take more risk, but only if they truly understood what they were doing. Graham warned that most people believe they are enterprising when they are actually reckless. One of his most controversial ideas was that the average investor should not try to beat the market. Not because it's impossible, but because the cost of trying, emotionally and financially, is often too high. Graham believed that avoiding major losses mattered far more than achieving extraordinary gains. A portfolio that compounds steadily for decades will always outperform one that occasionally explodes upward but repeatedly collapses. He emphasized that loss is asymmetrical. Losing 50% requires a 100% gain just to get back to where you started. That math destroys careers, confidence, and lives. Graham had seen it happen too many times to ignore. Instead of chasing growth, he focused on value. Not value as a buzzword, but value as a discipline. Buying assets for less than they are worth. Not because prices will rise tomorrow, but because reality eventually asserts itself. He didn't care when the market agreed with him. He only cared that the underlying facts were on his side. This approach required something rare, the willingness to look wrong. Graham taught that if you buy based on intrinsic value, you must accept that the market may disagree with you for a long time. That waiting period is where most people give up. They confuse price movement with truth. Graham never did. He believed that the market's job was not to inform you, but to tempt you. It tempts you to buy when optimism is high and sell when despair feels overwhelming. The disciplined investor learns to reverse this instinct, not emotionally but logically. Another insight Graham shared was that volatility is not the same as risk. Price fluctuations feel dangerous, but they don't automatically mean something is broken. True risk, in Graham's view, was the permanent loss of capital, overpaying, over-leveraging, owning businesses you don't understand, letting emotion dictate decisions. Those were the real dangers. This distinction changed how investing was taught forever. Before Graham, risk was often measured by how much prices moved. Graham reframed risk as the likelihood of irreversible damage. That shift alone saved countless investors from destroying themselves. During market downturns, he also warned against narratives. Stories are powerful. They make investments feel inevitable. Revolutionary technology, new eras, guaranteed growth. Graham had lived long enough to know that every generation believes it's different, and every generation is eventually proven wrong. Progress exists, but it doesn't eliminate cycles. Human nature doesn't evolve as fast as technology. Graham's skepticism wasn't cynical, it was protective. He believed that optimism should be earned, not assumed. When markets are euphoric, discipline feels boring. When markets collapse, discipline feels impossible. Yet those are the exact moments when discipline matters most. He encouraged investors to write down their rules in advance. Not during panic, not during excitement. In calm moments, because decisions made in emotional states rarely align with long-term goals. A written plan acts like an anchor when everything else feels unstable. One of Graham's lesser-known beliefs was that investing should improve your life, not dominate it. He didn't believe people should obsess over markets every day. If your strategy requires constant monitoring, it's probably too fragile. A strong investment approach should allow you to sleep at night. That philosophy stood in stark contrast to speculation. Speculation feeds anxiety. It demands attention. It creates emotional dependency on price movement. Graham viewed that as unhealthy and unsustainable. He also understood something deeply human. Regret is more painful than loss. Investors often sell, not because they've analyzed the situation, but because they can't bear the emotional weight of watching numbers fall. Graham's margin of safety wasn't just financial, it was psychological. It gave investors room to be wrong without being ruined. As he aged, Graham became even more convinced that simplicity beats sophistication. The more complex a strategy becomes, the more points of failure it introduces. Complexity gives the illusion of control. Simplicity forces honesty. This thinking influenced generations far beyond finance. Graham's work quietly shaped how risk is understood across industries. His insistence on evidence over excitement, discipline over impulse, and humility over confidence remains rare even today. Perhaps the most powerful part of Graham's legacy is this. He never promised certainty. He promised resilience. He didn't claim you could avoid losses entirely. He showed how to avoid catastrophic ones. That difference is everything. Markets will fall again. They always do. New technologies will rise. New bubbles will form. New narratives will capture attention. Graham's principles don't change because human behavior doesn't change. And that is why his ideas still matter. Not because they are clever, but because they are honest. Toward the end of his life, Graham was asked what had mattered most in his investing career. People expected a clever formula or a market insight. Instead, he spoke about temperament, about patience, about the ability to remain calm when others lose control. He believed that investing success had far more to do with character than intellect. By then, the world around him had changed dramatically. Markets were faster. Information traveled instantly. Speculation was no longer confined to professionals. Yet Graham saw the same mistakes repeating themselves, just at greater speed. People still chased what was popular. They still believed prices going up meant safety. They still ignored risk when optimism felt good. What worried him wasn't innovation. It was overconfidence. The belief that modern tools had eliminated uncertainty. Graham knew that no matter how advanced systems become, fear and greed remain constant. Technology doesn't remove emotion, it amplifies it. He warned that investors often confuse activity with progress. Trading more feels productive. Reacting to news feels responsible. In reality, excessive action usually increases mistakes. Graham believed that the best investors often look inactive. They wait, they observe. They act only when conditions are clearly in their favor. This restraint made many people uncomfortable. Doing nothing feels irresponsible when everyone else is doing something. But Graham believed discomfort was a signal, not a warning. If you feel pressure to act because others are acting, that pressure is often emotional, not rational. He also spoke about humility, accepting that you will be wrong sometimes, that your analysis will not always align with reality, that markets can remain irrational longer than you expect. Humility allows flexibility. Arrogance demands certainty, and markets punish certainty more than ignorance. One of Graham's most enduring lessons was that investing should be boring. Excitement is the enemy of discipline. If your strategy feels thrilling, it probably involves unnecessary risk. Wealth built slowly may not feel impressive in the moment, but it endures. Wealth built quickly often disappears just as fast. He believed that success should be measured not by peak returns, but by longevity. How long you stay invested, how consistently you avoid destruction, how well you preserve capital during inevitable downturns. Those who survive longest often win in the end. Graham didn't romanticize struggle. He didn't glorify losses. He simply accepted reality. Markets reward patience because patience is rare. Most people give up too early. They abandon sound strategies after temporary disappointment. Graham understood that consistency over decades beats brilliance over months. As the years passed, his ideas quietly spread. They shaped textbooks, influenced institutions, guided individuals who would later build extraordinary fortunes. Yet Graham himself remained understated. He didn't seek attention. He believed the work spoke for itself. What makes his philosophy powerful today is not nostalgia. It's relevance. Modern investors face more noise than ever. Endless opinions, constant alerts, social pressure to keep up. Graham's message cuts through all of it with a simple truth. Your behavior matters more than your predictions. You don't need to know what markets will do next year. You need to know how you'll react when they don't do what you expect. That reaction determines everything. Graham taught that wealth is not built by avoiding uncertainty, but by respecting it, by preparing for disappointment instead of assuming success, by protecting yourself against your own worst instincts. And here's the part that most people miss. Graham didn't believe investing was about money alone. He believed it was about peace of mind. Financial security meant freedom from constant anxiety. Freedom to focus on life, not screens. Freedom from the emotional roller coaster that destroys confidence and clarity. He wanted investors to build systems that worked even when they weren't watching. Strategies that didn't depend on perfect timing or constant decision-making. Structures that allowed life to continue uninterrupted. That may be his greatest legacy. Not a method for beating markets, but a framework for living with them. Benjamin Graham passed away in 1976, but his ideas didn't age. They hardened. They proved themselves again and again through crises he never lived to see. Each crash, each bubble, each recovery quietly reinforced the same lesson. The market will test you, not once, but repeatedly. It will test your patience, your confidence, your discipline. It will tempt you with excitement and punish you for surrendering to it. It will reward calm thinking and punish emotional reaction. Graham showed that you don't have to be extraordinary to succeed. You just have to be prepared. Prepared to think independently. Prepared to wait. Prepared to protect yourself when others are chasing illusions. In the end, his message was deeply human. You don't win by being fearless. You win by understanding fear and refusing to let it control you. You don't win by being certain. You win by building room for error. If there is one idea worth carrying forward from Benjamin Graham, it is this. Investing is not about predicting the future. It is about surviving it. Those who survive long enough, with discipline and humility, eventually discover that time does the heavy lifting. Markets rise, markets fall, but patience compounds quietly in the background. And years from now, when others wonder how wealth was built so steadily, the answer won't be brilliance or luck. It will be preparation. It will be restraint. It will be the quiet strength of not losing when others couldn't stop themselves. That is the legacy of Benjamin Graham, and it still works if you let it.